Everything you've been told about Bitcoin demand in 2026 is too simple. The market is not being led by buyers in one neat category. Right now, whales are soaking up supply while retail style flow is showing signs of stress, and that split is exactly why Bitcoin feels so confusing. Here's a payoff. We're going to break down one real market case from this week. Look at the numbers behind the whale bid, the ETF outflow, and the exchange deposit spike, then turn it into a practical way to read Bitcoin without getting fooled by headlines. Start with the biggest number. According to CoinDesk, Bitcoin whales bought $16.7 billion of Bitcoin in just 2 weeks. At the same time, ETFs bled a record $4 billion. That is not a normal market. That is a battlefield. And the key detail is this. US institutional demand had its worst month ever in June. That sounds bearish on the surface, and in a lot of cycles, people would assume that means price is about to collapse. But the bigger holders did the opposite. Large holders absorb the selling. That matters because Bitcoin does not move only on whether people are bullish. It moves on who is forced to sell and who is willing to buy size when everyone else is nervous. When ETFs are leaking $4 billion and whales are still adding $16.7 billion in 2 weeks, you are seeing a transfer of coins, not a simple demand freeze. So, who is actually driving the market right now? The answer is both sides, but not in the same direction. Retail investors tend to react to price. Whales tend to react to supply. That's why the same chart can look weak to one group and like an opportunity to another. In this case, the whale bid is strong enough to absorb a terrible month for institutional demand. That is exactly the kind of divergence that has shown up near past cycle bottoms, according to CoinDesk. But there is another signal that makes this even more interesting. The block reported that Bitcoin and altcoin exchange deposits have spiked, with Bitcoin deposits to exchanges recently climbing to nearly 49,000 BTC. CryptoClont called that a rare extreme and said it has only been seen 4 other times this year. That is a very different kind of message from the whale buying story. Exchange deposits usually suggest more coins are being moved toward trading venues, which can mean higher volatility ahead. So on one hand, you have whales absorbing supply. On the other hand, you have more coins entering exchanges, which often means the market could swing harder in either direction. That tension is the real story of 2026. If you only look at ETF outflows, you might think the market is broken. If you only look at whale accumulation, you might think the bottom is in. If you only look at exchange deposits, you might think a volatility spike is coming. The mistake is treating any one of these as the whole market. The better question is, who is doing the selling? Who is doing the buying? And where is the supply going? In this case, the answer appears to be that weaker hands and fund flows are under pressure, while large holders are taking the other side. That does not guarantee an immediate rally. It does suggest that Bitcoin is being accumulated by players with deeper pockets and longer time horizons, even as near-term sentiment looks shaky. So if you want one practical takeaway, make it this. Don't trade the headline, track the holder behavior. Subscribe if you want more strategies like this. Drop a comment with your biggest takeaway, and remember this is general financial information, not personal financial advice. Do your own research and size any Bitcoin exposure based on your own risk tolerance.